Good afternoon, everybody. Thank you for joining us today. So my name is James Pitt and I'm Head of Audit and Assurance here at James Cooper Preston. And I'm joined today by one of our audit directors, Sam Britton. And today we're going to talk you through the upcoming changes to Financial Reporting Standards 102, so FRS 102. So the purpose of today's webinar is to really highlight the key changes to FRS 102, enhance your knowledge so that you have an understanding of the changes and what impact that they may have on you and your businesses, and also give you some guidance on what you can start doing to prepare for these changes. So in terms of the agenda and what we're going to cover today, so we firstly start by talking about why the changes have been brought in, what the changes are based on, and the timing of the amendments. We will spend some time talking about how the changes could affect you and your business. We will talk through the two key changes in relation to revenue recognition and leases. We will briefly touch on some other amendments within the revised FRS 102, and we will talk through what you can be doing to prepare and end with some questions at the end. So the webinar in total should last around 45 to 55 minutes. And if you do have any questions, then please use the Q&A button on your screen, and we will take questions at the end and take as many as we can within the allocated time. So let's move on to the changes. So the basis of the changes, so why have the changes occurred? So the Financial Reporting Council do a periodic review of the financial reporting standards every 5 years and bring about changes that they believe are appropriate. And these are the changes that are coming into effect are probably the most significant changes we've seen in the UK since the new UK GAAP was brought in a decade ago. And why have the changes been made? So the changes have been made with the expectation to provide greater consistency of financial reporting information and align the current UK accounting standards with international accounting standards. And a lot of the changes that we're going to talk about relate to revenue and leases. So the hope is that there will be a better understanding of revenue recognition requirements and more information in the financial statements about leases with assets and liabilities being recorded on the balance sheet. And these changes are very much based on international financial reporting standards. So IFRS 15 revenue from contracts with customers and IFRS 16 leases for those of you that are familiar with IFRS. So what's the timing of the changes? So the timing, the changes come in for accounting periods beginning on or after 1st of January 2026. So in essence, that December 2026 year ends, unless you have a short or long period, and then it might be slightly different. And the amendments do allow for early adoption for those that want to adopt early. So how could the changes affect you? So of course, with any changes to financial reporting requirements, there is a time cost to understand the changes, and there is a real cost in the form of accountancy fees or professional fees to enact the changes. So on the next slide, we have a number of commercial considerations that you should also consider. So just wait briefly for the next slide. So what kind of things should you be considering? So the changes to revenue and leases, as when we go through them later, you'll see that they could impact key financial metrics such as revenue, profit, EBITDA, net debt, and gross assets. And these key metrics, financial metrics, may have wider implications and commercial implications. So For those businesses and entities that have borrowings, there may be debt covenants that could be affected by some of these changes. The company size classification is based on key metrics, and two of those are linked to revenue and gross assets. So changes to revenue and leases could have an impact on the company size, and that may mean that you are within or without the scope of audit or certain disclosures. If profits are recognised in different accounting periods, there could be changes to corporation tax liabilities, and not only just changes to the amounts that are payable, but also the timing of the payments. So there could be some cash management considerations. Other than that, there are other things to consider, such as remuneration and bonus schemes. So if there's any bonus schemes or share option schemes linked to financial performance, you need to start considering whether these changes will have an impact on those. And finally, dividends. So some of these changes may impact not only the current year performance and distributable profits, but also retained earnings, and that may have a knock-on effect in terms of dividend policies and tax planning strategies. So these are just some of the changes that could arise as a result of the amendments to FRS 102 and some of the things that you need to be considering. So what are the key changes? So I've mentioned a couple of times now that the key changes really relate to revenue and leases. So very high level, in summary, in relation to revenue, the amendments and the amended standard is going to bring in a 5-step model that should be applied to all contracts that basically is set on a 5-step model about identifying performance obligations and recognising revenue in accordance with the completion of those performance obligations. And when looking at leases, again, very high level, the change effectively removes the classification of operating or finance leases and brings leases onto the balance sheet in the form of assets and liabilities. And there are some certain exemptions for that Sam will cover on a bit later on. So let's look at revenue in a bit more detail. So under the current standard, revenue is measured and recognised at the fair value of consideration receivable, whereas I've just mentioned the new standard brings in a 5-step model, which very much focuses on identifying the distinct goods or services promised to a customer, the amount of consideration the business will be entitled to, and the pattern of when those obligations are completed. So if we go to the next slide, the 5 different steps are on the screen. So step 1 involves identifying the contract or contracts with the customer. Step 2 involves identifying the performance obligation in the contract. Step 3, you are required to determine the transaction price. Step 4, you are required to allocate the transaction price to the performance obligation in the contract. And the final step is to recognise the revenue when or as the entity satisfies a performance obligation. And if we just look at those steps in a bit more detail, so step 1, so the initial step for an entity when applying the 5-step model is to firstly identify the contract or the contracts and what the company is committed to providing in terms of the good or the service to a customer. And the entity shall only apply the revenue recognition model when all of the following criteria are met. So the parties to the contract both approve the contract and are committed to performing their respective obligations. The entity needs to be able to identify each party's rights regarding the goods or services to be transferred. The entity needs to be able to identify the payment terms for the goods or services to be transferred. The contract has to have commercial substance. And finally, it needs to be probable that the customer will have the ability and intention to pay the consideration that the company will be due when it is entitled to it. So 5-step model, that was step one. There's also guidance in standard on combining contracts. So this is new to FRS 102. There's nothing in current standards. And the standards state that when an entity enters into 2 or more contracts in or at or near the same time with the same customer, they should be accounted for as one single contract when either the contracts are negotiated as a package with a single commercial objective, or when the amount of consideration to be paid in one contract depends on the price or performance obligation of the other contract, or finally, the goods or services promised in the contracts are one single performance obligation. So that's new to the revenue standard as a result of the amendments. And then also in step one of on the section where step one is defined in standard, it talks about contract modification. So again, a new concept, and it highlights what a contract modification is and how you would account for that contract modification. And how you would account for it does depend on the scope of the changes and the corresponding change in price. And some of the options or the ways that a contract modification should be accounted for, it may be that you account for the modification as a totally separate contract, a termination of the existing contract, and then a new contract, or the modification may lead to recognising a cumulative catch-up of revenue, and the exact treatment will depend on the exact circumstances. So moving on to step two. The second step is to identify the performance obligations in the contract. So what is a performance obligation? So a performance obligation represents a promise in a contract with a customer to transfer to the customer a distinct good or service, or a series of distinct goods or services that are substantially the same and have the same pattern of transfer to the customer. And the standard goes on to talk about a distinct good or service, and a good or service is distinct if both the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer, and the entity's promise to transfer the good or service is separate from other promises in the contract. So we've got an illustrative example on the next slide, just to show how that works in practice. So the example on the screen, JCK Limited enters into a contract to provide a customer with a software license, installation and ongoing updates, with technical supports being provided for the next 3 years. And in this example, each element can and is sold separately by JCK Limited, and the installation can be performed by other parties, and the software continues to operate without future updates. So we're going to go to a quick poll. So partly just check everyone's still listening and still awake. Appreciate it's a session just after lunchtime. So hopefully you all have a poll question on your screen. So could you, in the above example, could you please answer the question, how many performance obligations are there in the example above? And we'll just give everybody 30 seconds just to answer the question and see what the results come in at. Just waiting for those answers to come through. Still just waiting for a few more to answer, just waiting for the results to come through. Okay, so Okay, so the answers are just coming through. Okay, so there's only two answers, which is good. So nobody went for one or two obligations, which is good. So 43% of people selected or thought there were three performance obligations, and 57% thought that there were four. And I can say that the 57% is correct. So well done those that have selected and answered four. So the four performance obligations in the example above, one, there is an obligation to provide software license. Two, there is an obligation to provide installation services. The third performance obligation is to provide updates, and the fourth obligation is to provide technical support. So a bit of a challenging question, which I guess is reflected in the results. And just to go to show that there is judgment involved and highlight how important the detail is in the example that we've kind of just talked through. If the software installation and the could only be provided by the software license company, then there would be three performance obligations, with the software license and installation being one performance obligation, and then the updates being the second, and finally the technical support being the third. So again, fine details, and it can make a difference between there being three performance obligations or four. And I suspect some people may have thought or considered the installation, or sorry, the updates and the technical support as one performance obligation. So you do need to look at the detail, and ultimately it's for management to make a judgment based on the information in the contract. So moving on to step 3 of the model. So step 3 involves determining the transaction price. So the transaction price is the amount of consideration an entity is entitled to receive in exchange for transferring goods or services to a customer. So be careful here. The guidance suggests or states that the transaction price can include variable amounts, and that these need to be considered further. And variable amounts of consideration could be things such as rebates, refunds, or discounts. And where there is variable consideration, the amount of variable consideration to include in the transaction price must be estimated by management by using either the expected value method or the most likely amount method. And the method to use is the one that predicts or is most accurate, effectively. So and the standard also states that variable consideration must only be included to the extent that it is highly probable that the entity will be entitled to it, and when the uncertainty related to the variable consideration is resolved. So again, there's a bit of judgment there in terms of, will the variable consideration be recoverable, and ultimately how much should be recognised. The revised standard also has guidance on deferred payment terms beyond normal business terms, and that's where you would consider discounting payment terms that are received in the future, depending on exactly how long it is before the cash starts to come through, and also non-cash consideration. That's where you would look at the fair value of the services being provided. So moving on to step 4. The fourth step in the 5-step model is to allocate the transaction price to the performance obligation or the performance obligations in the contract. And the transaction price should be allocated to each distinct performance obligation based on a relative standalone selling price. So this is the price at which an entity would expect to sell a good or service to a customer. And if a standalone selling price is not directly observable, then one should be estimated by management using the information it has available in terms of market conditions, entity-specific factors, or any other information available to management that comes up with a standalone selling price. So if we just go back to example 2, for example, the transaction price for each different performance obligation should be allocated. So there would be a transaction price for the sale of the software license. There would be a transaction price for installation, a transaction price for updates, and then a transaction price for ongoing support. So you would allocate, or management would allocate, the transaction price across the 4 distinct performance obligations. Step 5, so the final step in the 5-step model is to recognise revenue as the performance obligation is satisfied. So a performance obligation is satisfied by transferring the promised good or service to the customer. So a good or service is deemed to have transferred to a customer when the customer obtains control of the good or service. So the standard says that performance obligations can be satisfied over time or at a point in time, and how you recognise revenue will depend on the facts, circumstances. So the 5-step model sets out the criteria that must be met for a performance obligation to be satisfied over time, and if a performance obligation is not satisfied over time, then it is satisfied at a point in time. So just exploring those concepts in a bit more detail. So revenue that is recognised at a point in time, to determine at what point in time it is that the customer obtains control of the asset. An entity needs to consider lots of different indicators. So things that could be considered are whether the entity has the right to payment, whether legal title of the asset has passed from the business to the customer, whether the customer is in physical possession of the asset, whether the significant risks and rewards of ownership passed, and another indicator could be that the customer accepts that they control the asset. And then looking at revenue recognised over time. So revenue is recognised over time when one of the following criteria is met. So only need to meet one of the criteria. So the customer simultaneously receives and consumes the benefits as the entity performs. So an example of that would be, for example, a cleaning service. So the cleaning service may be provided by the company. The customer is benefiting from the service over time, and in that instance, the revenue would be recognised over time. The second one is where an entity forms, creates, or enhances an asset that the customer controls. And an example of that would be, for example, a construction contract. So a building works may be completed on the building and the over time. So the company is providing a service over time, but the customer has control of the asset and control of the building. So that would be an example of where that would be applicable. And finally, an entity's performance does not create an asset with an alternative use to the entity, and there is an enforceable right to payment for performance completed to date. So that would be where a business or a company is performing a service just for that company, and that company is the only one to benefit from that, and it can't be used elsewhere, or there's no IP being developed that could be used elsewhere, and then there is an enforceable right to payment for performance completed to date. So I guess an example there could be something like professional services and a statutory audit. So the company or the firm will provide the audit, it's just for that entity, can't be used elsewhere, and the auditors are entitled to payment. And in that case, the revenue should be recognised over time. So the standard gives 2 different methods of recognising revenue over time, or certainly measuring progress. So it talks about an output method and an input method. So the output method is looking at outputs such as physical surveys of work done, number of units physically delivered, and the passing of time, if the services are delivered evenly over time, or input methods. They could include things such as costs compared to total costs incurred, labour hours incurred over kind of total labour hours, and again time. So a couple of different methods and different measures that management can use, and ultimately is up for management to select the most appropriate method for measuring progress. So that's it in terms of the 5-step model. So other considerations that you need to be aware of. So there is guidance in FRS 102 for warranties and non-refundable upfront fees, licensing, refund liabilities, and sales with rights of return. And we won't go into those into great detail today, but that's there's guidance in the standard which is new compared to current UK GAAP. So kind of talk through the revenue changes, but how do you enact the changes? So the amended standard provides 2 options for transition to the effective standard. So option 1 is that you can do a full retrospective restatement. So this is where you restate the comparatives using practical expedients to make it slightly easier, but you restate the comparatives as if the standards have been effective for before the transition date, and restate all your numbers. Or there's an alternative approach, which is known as the modified retrospective application, and this modification or this transition allows you to enact the changes without restating the comparatives, and you are just required to put a adjustment through opening reserves for the cumulative effect of the changes. So again, there are practical expedients available to make it slightly easier, and again, it is a choice as to which policy you choose. So just to conclude on revenue, the 5-step model is new. It will take some time for everybody to get used to it. However, once it is adopted, there should be a unified revenue recognition model, and that should lead to more consistent and comparable accounting practices. And the hope is that this will enhance the quality and reliability of information included in the financial statement. So that's it on revenue. So I'm now going to hand over to Sam Britton, who will talk through the changes to leases. So over to you, Sam.
So thank you very much, James, for that insightful overview on the revenue changes. And similarly, so leases have also had a fair overhaul, should we call it, in the revised standard, certainly compared to what's existing at the moment. And again, it's all linked back to IFRS, and leases under IFRS is under IFRS 16. And the current position under FRS 102, for those who are familiar, will recognise the distinction between operating leases, where there's a rental expense to be charged through profit and loss over the life of the lease, and finance leases, where substantially the risks and rewards associated with that lease are transferred over to the lessee instead of remaining with the owner. And such finance leases, as they stand at the moment, you'll have an asset and a liability recognised on the balance sheet, each of which will unwind itself either via depreciation, or liabilities will be subject to the interest charges. Now, critically, as James mentioned towards the start, that separation distinction has now disappeared, and there's no more terminologies around operating and finance leases under the revised standard. So fundamentally, all leases as a lessee, with very few exceptions we will touch upon in a few slides' time, will now all be recognised on the balance sheet. For those who are lessors, life is a little bit simpler because there is fundamentally no change in the recognition. So all of the following slides to come will be meaningful and impactful for any lessee company more specifically. Now, before getting into any lease calculations in a similar vein to all of the relevant standards under FRS 102, we need to be quite clear that actually the contract is representative of the lease, and the definition of such a contract is there. So we just brought up on screen the definition under the revised standard, being that a contract or part of a contract that conveys the right to use an asset for a period of time in exchange for consideration. And the most important element within that definition is this right to use concept. So very much as a lessee, you're now having the ability to direct how that asset is being leased, is being run, and for what purpose the asset is used throughout the period of the use. So it's no longer the lessor who's having that entitlement, it's the lessee who is actually having the right to use it and in certain ways. And quite critically, it's all about control of that asset, and that the lessee is obtaining substantially all of those economic benefits from the use of that asset. So if you have a contract that is meeting those criteria, then first and foremost, you need to be confident that it is meeting the definition of a lease before getting into the more detailed calculations behind that. So having determined that you do have a lease as a contract, we then need to think about what the measurement principles are. And the first point within that is actually the lease liability has to be determined first. And that lease liability is equal to what's called the present value of the lease payments still to be paid, which fundamentally means what are those future payments meaning in today's money and in today's value. And that effectively comes about by discounting a number of different considerations, which we'll just talk about in just a moment. Now, having determined that lease liability first, that becomes your corresponding right of use asset opening cost value, again subject to a few little markers around that, which we'll touch on the next slide now. So lease liability, as I say, present value of those lease payments outstanding, and they can be made up of up to 5 different potential payment conditions. The first of them being outright those fixed payments, which should be quite clearly stated within the contract and the lease conditions themselves. However, you might find you have certain variable payments in existence as well. But most critically, they must be dependent on an index or a rate. And the 2 key examples there is the consumer price index or potentially a benchmark interest rate that might be available. And if those exist, critically again, on the commencement of the lease, so not necessarily in the future, but on the commencement of the lease that you will know with certainty at that date, then those variable payments must also be taken into consideration in the determination of your lease liability. Another element that has to be added into those payments to be discounted is any payments for residual value guarantees. Now, residual value guarantee is where a separate third-party organisation, and that's separate to the lessee and the lessor organisations, is guaranteeing to the lessor a residual value of that leased asset at the end of the lease term. So if you have any such payments at the end of the lease term that are being guaranteed as such, you'll also need to include those in your payments to be discounted. If there exist any exercise prices for purchasing the asset at the end, and you have the option to do so, if it is reasonably likely that you will take that option, those payments should also be included. And lastly, if there do exist any penalties for terminating the lease, and you think you are likely to terminate such a lease early, those penalties also need to be included in the lease liability calculations to then discount to present value. And then, as I just mentioned, all of those relevant elements coming together being discounted would be the starting point for the cost and the opening cost for your right of use asset. However, that right of use asset value may then differ to your lease liability for 3 different reasons. The first being whether there are any initial direct costs being incurred. And that, for examples, there would be transaction costs or anything associated with installation that may come up. Sorry, Gabe, you just go back a slide. And then also, if there are any lease payments made or lease incentives received for commencement of the lease, they need to be added or deducted concurrently into the right of use asset cost. And the last point is whether there are any estimates for obligations within the lease agreement for costs to dismantle or restore the asset to its original condition at the end of the lease, most commonly otherwise known as provisions for dilapidations. And you also have to bring the asset value side of those into the right of use cost. Now, again, there's a critical condition within the last point there around dilapidations, and it's very much to do with those dilapidation costs associated with the asset and the capital element, as opposed to any more general wear and tear that could happen, scuff marks on the wall, for example, just from using the leased premises primarily throughout that point. So it's very much to do with the asset-related capital dismantling costs that may need to be included. And all of those have to be done on the commencement of the lease. So there's clearly a lot of judgment and estimate of things that will come about in the future that have to be determined that may not be known with a great deal of certainty from day one of the lease, but various things that need to be taken into consideration to get your opening numbers on your balance sheet. So I've touched upon the word discounting for determining the present value of the lease payments outstanding. And there's essentially a hierarchy of how those discount rates should be determined. And so the next slide will reflect on the first of these, which has to be used first, is the interest rate implicit in the lease. But it does state under FRS 102 that it's only if that rate can be readily determined, which I'm sure therefore indicates that there must be times where that can't be so. And that may be more common than it may not be, for that not to be determinable. And the two elements, the definitions on the right of the screen there, which capture be a bit more tricky potentially to assess and determine, is within part B1 and 2. So will you as a lessee be able to determine the fair value of the underlying asset at the commencement of the lease? And will you also be able to determine and know with the initial direct costs of the lessor? And if you can't actually determine those with any great deal of certainty and probability, then you might not be able to have that interest rate implicit in the lease readily determined. And that therefore will not give you the discount rate based on what should be the first option. So if that is the case, we move on to the lessee's incremental borrowing rate, which is defined under the FRS 102 as the rate of interest a lessee would have to pay to borrow over a similar term and with a similar security, the funds that are necessary to obtain an asset of a similar value to the right of use asset in a similar economic environment. So quite a few different elements going on within that definition, but the core point to it is it's of the same value fundamentally, but for a similar asset. And that distinguishes, if you can't determine that particular incremental borrowing rate, to the last option, which is the obtainable borrowing rate, whereby the obtainable borrowing rate takes out the equation of an asset of similar value. And it's more generally, what would the rate be if you were to borrow such a similar size amount of money for this in terms of the undiscounted value of those lease payments? So just to recap on that, because a few points going on, you need to first determine, can you work out the interest rate implicit in the lease? And you'd use that as your discount rate if you can. If that can't be determined, you use the lessee's incremental borrowing rate. And then lastly, if you can't determine the incremental, you'd go for the lessee's obtainable borrowing rate. And then the last point in relation to the initial measurement of your lease liability is, what's the lease term? So how long a period are we actually incorporating all the payments that we mentioned earlier? And so on the next slide, it'll bring up three core points that are under FRS 102 that define what your lease term is. The first of these is the non-cancelable period of a lease, which should be the more factual of the three, because that should be outright defined in your lease agreement. However, there's then two others which may or may not exist. And if they do, then you must be mindful as a management team to take the right options in relation to these and include or not include them appropriately. So the first of these is periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. Or you may have periods covered by an option to terminate the lease, but only if the lessee is reasonably certain not to exercise that option. And so to put that into perspective, we have got another example to bring up on screen. And once I've read this through, we will also go to another poll for about 30 seconds to see what people's perspectives and views are on this one. So the example is JCK Limited is leasing an office building for a non-cancelable 10-year lease contract. Within that lease agreement, there is an option to extend that lease term for 5 additional years, but with no change to the rental value from day one of the lease. This office building is in a very beneficial area to the operations of the business, and the market lease rentals in that area are expected to increase by up to 20% over the next 10 years. So the key question is, what is the lease term? Do people think it's 10 years, or are we thinking it's 15 years? And so you should now get a poll up on your screen to select either 10 years or 15 years. And we'll give you about 30 seconds or so again to work through that. And then we'll have a debrief in just a moment. Just wait for a few more answers to come through and then we should be good to carry on. And there we have it. So a bit more of a wider variation in answers compared to the revenue earlier. So those with the 10-year response is 32%, and those with the 15 years is 68%. Now, the interesting point with this one, in bringing up the answer now, is that it actually depends a bit on what the circumstances are for a business. And it might not be so clear-cut as the revenue one earlier. Now, the answer we've considered here is 15 years would be the suitable response. But it really does depend. It's very judgmental. And the various things to think about in determining what your lease term is and the onset on the lease is this an extension of an existing lease? You know, how long have you been in that building previously? What actions have been carried out with previous leases before? How long have you been there for that purpose? What are your longer term growth plans as a business? You know, have you moved into a brand new offices with a lot of potential for growth in the next 10, 15, 20 years as a major strategy? Now, the indicative answer here is 15 years, I say, and probably the most important element to that is the benefit of the equal rental value, whereas the rest of the market will go up 20% over the next 10 years. There's a clear economic benefit there, and it's still under this assumption that it's going to be of a very beneficial area to be operating as well. But this should give an overview that it is not necessarily a simple answer, and you do have to take into account various different circumstances which you may or may not yet have experienced as an organisation to determine your suitable lease term. And the last key point to note is that you will have to keep this under a constant revision and watch. So this judgment will not remain true for the whole point of your lease from day one, as these circumstances may change over time. And if you deem that one of those circumstances has changed and you need to revise your lease term, there will be clear implications of needing to revise your resulting financial statements and the numbers contained within there. So all of those recent slides have been talking about the initial measurement of your lease liability and your right of use asset cost value. But we're now going to move on briefly as to what the subsequent measurement is and what happens throughout the period of that lease term that you have determined. So on the right of use asset side, you've got three options. You have cost less depreciation and impairment policy, where you will then depreciate the right of use asset over the lower of the useful economic life and the lease term. You have the revaluation model option, which will follow very similar to existing tangible fixed asset revaluation models under Section 17 of FRS 102. And if the right of use asset so happens to relate to investment property, which has to be measured at fair value under FRS 102, then the right of use asset must also be measured at fair value through profit and loss. So what should in principle be the simpler and maybe the most common to be used, and it certainly has been under IFRS at least, is the cost less depreciation and impairment route. And the lease liability, that will change its measurements subsequently in a different way to the right of use asset. And therefore, when you are getting your lease payments being made to the lessor, you will deduct those payments from the value of the lease liability. And the previous discounting to take your initial measurement down to present value, that discount we mentioned earlier, that will now start to be unwound as an interest cost through profit and loss. And that's how the lease liability will also come down to zero at the end of your determined lease term. So I did mention towards the start of the leases as well that not every lease will come onto the balance sheet, and there are just a few exceptions to that particular point. And there's two that will come out from that. So the first of those is what is called short-term leases. And as it will show in the next slide, they are particularly leases for 12 months or less on the term and no purchase option in existence. And there are those then that are called low value assets. Now, IFRS 16 has been particularly helpful in its guidance to give a defined value for low value assets being $5,000. Interestingly, is US dollars. However, FRS 102 has not taken the same route to define a low value asset. So it does really put the onus on a management team to consider the nature of the asset. But quite interestingly, it has actually given examples of assets that are not of low value and are typically expected to be incorporated as leases, which will be on the balance sheet. So such as office buildings, large items of machinery and other plant equipment, cars and other vehicles. And if you see that list in FRS 102 and sort of turn it on its head a little bit and maybe apply a similar concept to what guidelines are stated for IFRS at least, areas and items such as laptops that are leased or small office furniture, they might be more possible low value leased assets, which you do not need to put on your balance sheet. And the simple reason for accepting those is the accounting treatment is an awful lot easier to apply. And very much in the old operate and lease perspectives, you will just spread and charge the leases cost through your profit and loss for those either short-term leases or low-value leases on a straight-line basis, or possibly another systematic basis if that's a bit more representative of the real usage from that leased asset. And then lastly on leases as well is the point around transition. So similarly to revenue, how do we actually bring this into our financial statements and our management information from the 1st of January 2026? In a different mindset to revenue, however, there is no requirement to restate your comparatives. And so with leases, you will only bring those into your results from the 1st of January or your opening period for your financial statements post that date, with an adjustment to cumulative historical retained earnings needing to be made. So for any leases that are being identified, you will need to go back to the start of that lease date to work out all the mathematical models and results for that, even if that date is prior to the transition date. But any historical profit and loss impacts that would have been accounted for in prior years will then be adjusted for cumulatively in your opening retained earnings on the transition date. So there is a slight distinction to the revenue mentioned by James earlier on for that particular point. And if you so happen to be a UK GAAP or FRS 102 reporter who is part of a much larger group who report under IFRS standards, you will have been presumably quite consistently reporting internally with management information to group some IFRS 16 based lease results. And there is also an exception allowed that if you're in such a situation, you can use your existing internal group reported lease values on the transition date to incorporate now into your UK GAAP financial statements. So there's some benefit there if that applies to you. So that brings about the leases. And again, there's various different elements, very much similar to revenue, that need to have a lot of careful thought and time to process different judgments and different estimates to be applied in advance of this transition actually coming into existence. Now, having actually spoken a lot there between the two of us about revenue and leases, there are various other much smaller, in the grand scheme of things, much smaller amendments to FRS 102 that we just very briefly want to draw your attention to. But I guess in general with these, there are a lot more clarification points, a lot more guidance being given and fundamentally overhauling the standards, unlike revenue and leases. So the first of those is under section 1A, which is to do with small entities, where previously there's been more encouragement of certain disclosures to give the accounts a true and fair view, but may not necessarily be required. However, the revised standard will make these disclosures a bit more expected than encouraged to give the true and fair view. And just some examples in there include disclosures around going concern, provisioning, perhaps share-based payments, and deferred taxes and dividends as well. Section 2 is the fundamental principles that underpin the financial reporting framework. And again, there's just been an update within that around aligning those definitions to the international framework. So not really changing the basis entirely, it's more the definitions within those. And in terms of fair value measurements, again, there's more alignment in the definitions and a bit more guidance around these definitions of sort of transaction costs, a hierarchy for fair value measurement. And again, it's just aligning to the international standards once more. The one that maybe has a little bit more implications, if applicable, is that to do with statement of cash flows, which does come in a year earlier for supplier finance arrangements. So where you have an arrangement for a third party to pay your suppliers at an earlier point, and you then have time to pay that third party, any outstanding liabilities in existence at the year end or reporting dates such as those, additional disclosures will be needed around the key terms, the balances, and what the aging of your liabilities to the third party are. And that will be a bit of a new transitional change for disclosures if they apply. Business combinations, again, some more additional context being included, but particularly around distinguishing any contingent consideration from any what might be ongoing remuneration. That can often be quite difficult to determine within any share purchase agreements, for example. There's a bit more guidance now under FRS 102 to come in around that area in particular. Share-based payments, a bit more guidance around certain situations, certainly in relation to business combinations again. Income tax is another one that's got some more guidance, but certainly around uncertain tax position and when you should be recognising any tax liabilities or even potentially assets for certain situations that are uncertain of their outcome with HMRC. And that guidance is given a bit more clarity on when to recognise those in relation to the information that HMRC will have for them to determine an outcome on an uncertain tax position. And lastly, one which is maybe not frequently seen, probably more towards the back of the financial reporting standards, is that of specialised activities. And there's a few more improvements and clarifications there as well, including on heritage assets and non-exchange transactions for public benefit entities. And with that, I'll hand back to James to just summarise again all the points we've just been talking about.
Thanks, Sam. So that was really helpful. So I guess we've gone through the changes. We've talked about revenue. We've talked about leases and hopefully and the other amendments that are coming into effect. So hopefully you have a high level understanding of the key changes and certainly an awareness of what areas you need to start considering and what commercial impact these changes may have on your business. So obviously the effective date is 1st of January 2026, which is not too far away. Time does fly very quickly, so we would recommend that everybody starts preparing for these changes as soon as possible. So what can you be doing? So firstly, we would suggest you conduct an initial impact assessment. So consider the changes we've talked about today. Do calculations, prepare calculations if you need to, and start to consider the impact on the profit and loss account and balance sheet, and whether what if any the adjustments are and what implications they may have on your business. And it may be that once you've done that, you can plan your next steps and whether you need to start worrying about whether you may fall into audit scope, out of audit scope, whether you need to consider changing accounting processes or accounting policies to extract the correct information, or any other commercial implications that we've gone through today. So I appreciate we've covered quite a lot today, and some of the things that we've covered may sound quite daunting, but if you do need any assistance, then we have an excellent team here at James Cooper Preston, so please do contact us. We can certainly help you navigate through these changes. So please feel free to contact your engagement partner, those of you that are existing clients, or contact Sam or me, and we can provide assistance if you wish. So that's the end of the formal presentation. So at that point, I would like to thank everybody for their attention and joining us today. Before we do finish, we said we would take any questions that were raised during the presentation. So if you do have a question, feel free to pop it in the box. The one that has come through, that came through earlier, somebody asked if you need a signed contract to be able to recognise revenue. So if you go back to step one, the standard says that you need to have approved it, and so that doesn't necessarily mean you need a signed contract. Some businesses obviously work under purchase orders. Once you get a purchase order, you take that as the agreement between the two parties to deliver a good or service, so that would be fine. If you had a more substantial contract that was complicated, then it would need to be agreed, by both parties, and in that instance, a signed contract may be in place, because there could be questions about the recoverability if it's not signed, questions as to why it hasn't been signed, and whether the contract has been, or in that instance, has been approved, and whether the collection of that monies receivable is likely. So just waiting to see if there's any more questions. So no more questions coming.
One other one has come through through the chat actually for us, James. Might be asked elsewhere. So the questions come in as for FRS 105, and I appreciate we focused on FRS 102 specifically here. So FRS 105 for any micro entities. And the question is, what's the impact for those reporting under FRS 105? And it's two different answers actually. So those in relation to revenue be the exact same as everything we've mentioned earlier. So everything James covered for revenue under FRS 102 and the 5-step model will be consistent for FRS 105. However, life will be a little bit simpler for FRS 105 micro entities when it comes to leases. And where I mentioned earlier on about the distinction will be gone for FRS 102 for operating and finance leases, actually for micro entities under FRS 105, that distinction will still exist. There will still be operating leases and finance leases for micro entities.
Thank you, Sam. So I guess finally, I would just like to thank you all for joining us today. Have a great rest of the day, and please do get in touch if you need any assistance. So our contact details are on the screen and on our website. So feel free to contact us if you wish. So thank you very much.
Thank you very much, everyone.